Well, hello everyone. This is Kat and Yesenia from Tobias Financial Advisors. Thank you so much for joining us today. Every quarter, we try to bring you educational content that's related to your finances and that is both practical and fun. This month's topic is solving life's problems with your employee benefits. So, let's say that I offered you the opportunity to spend $6,000 of somebody else's money at a store. Do I have your attention yet? How many of you would make sure to spend every dime, even if it meant that you have to put about 500 bucks of your own money? Are your hands raising up? How many of you spend the time and map out your strategy so you could get exactly what you wanted? Of course you would. That's exactly what open enrollment is like. It's free money, and everything in the store is designed to create safety and security for you and your family.
Hi everyone, this is Yesenia. So Kat, the problem is that over half of employees are spending less than 30 minutes making decisions that could really impact their lives. 40% don't even feel like they understand the choices they're making. And it's a valid concern. There's so many options out there. How do you choose what's the best one to pick? And over half of these employees are leaving employer money on the table, not even their own. So what happens, so what frightens me the most is that 42% are relying solely on these benefits to protect them, and that's really concerning. Now, because employee benefits serve as the financial foundation for most people, it's really that first line of defense. It's really important to see how these benefits can solve your own individual life problems. In addition, many benefits packages are using purchasing power of many people to create plans that you couldn't get out in the open market at that same low rate. Other benefits are subsidized by employers, and if they can serve a purpose in your life and you don't use them, then you're just leaving money on the table.
And of course, one of the problems that we see is that people treat employee benefits like products instead of solutions to life's potential problems. When we look at benefits as a product, we get focused mostly on price. Instead, if we look at benefits as a way to solve our problems, then our examination and process will change. Think about how you personally evaluate buying a product that doesn't bring you much joy and that you definitely need. How do you evaluate it? Well, most people first think about cost. In the past, when I was signing up for employee benefits before I was a financial planner, I would be most concerned with what was leaving my paycheck. I think, well, my eyes are fine. I'll skip vision this year. Disability, I don't plan on being disabled this year, so I'll skip that one too. So I would look at the bare minimum of what I was sure to need, and I didn't think about the possible financial consequences if I was wrong. So in evaluating products, most people start this process thinking about what's the product description. After looking at costs, we may spend a few minutes to see if there are similar products that cost less. It's not very exciting, so we try to rush through the choices and don't take the time to look under the hood. What we have found is that people's process and thinking changes when you think about solving a problem. You want to ask yourself, what's my problem and what is the scope? Which of these products or combination of products will solve my problem the best? The characteristics and details become important to make sure it's solving the problem. When you do that, then you're going to have a greater sense of urgency, and we see that that's worth more of our time. Now, something that we like to remind our clients is that the first rule of risk management is to cover any risk that could catastrophically mess up your life, okay, that has catastrophic consequences. And most employee benefit programs are actually designed to do just that. Employers know that employees dealing with a financial stress due to issues not being covered will cost them money. It doesn't just cost the employee money and stress, but it impacts their ability to focus on work. Yeah, your productivity will definitely go down if you're stressed out that somebody is in the hospital and you don't have the funds to pay for it. So even though your employer is offering these benefits for recruiting, retention, and because it's the right thing to do, there is some self-motivation here. They want to keep you healthy for a reason. So let's start looking at our standard benefits from the point of view of solving life's problems and how it could offset some of the expenses, but not just as products that are off the shelf.
So we all know that if you have uncovered medical bills, it can truly wreck your life. We see appeals on TV, we see all these crowdfundings on the internet, people just asking for help to cover expenses, or even stories of families losing their homes as a result of unpaid medical bills. So even with coverage, those bills really can just start to run up and mount up to something extraordinary. We even read a story about someone who didn't understand the insurance system. She didn't spend any time at all and actually chose the cheapest medical plan, which was to her detriment. When her husband spent 6 months in the hospital, she said yes to any procedure that the doctors wanted to do for him. And of course, that's what a good wife would do, or a good spouse, good husband. They're just going to say yes and give them any treatment that the doctor thinks is best. But she really didn't understand the pre-approval process, or didn't even think about money at all in that situation. It's really hard to. So when her husband got out of the hospital, she actually ended up owing $40,000 at 21% interest because she wasn't a savvy consumer. She could have still gotten great treatment for him, but she could have walked away with a lot less bills. Had she learned to evaluate the insurance, it would have been a different story. Since then, she has learned to look carefully at policies and engage doctors, hospitals, and systems to answer questions and make sure she gets as much coverage as possible from the insurance company.
And I'm sure if we all reflect, we may know somebody in our family that has gone through this. So this is near and dear to most of our hearts because we know that a medical expense could really bankrupt a family.
Absolutely.
So when protecting yourself against medical bills, the basic questions that you need to ask are here on the screen. The first one is, who needs coverage? Is it just you or you and a spouse? What about children or young adults? Or are you hoping to have a baby, or is one on the way? If your child is under the age of 26 and out of the house, it's easy to think that they're on their own, but if you would co-sign for them to get a treatment that would save their life, then it's important to think if they need coverage and include them in your evaluation. And we're using the age 26 because children can remain on parents' coverage until that age. After that, we'd recommend parents insist that their children have coverage, and if they're not going to get it, then it may be a good idea to pay for the premium. And we see this a lot. People may dig into their retirement savings because they want to offset somebody else's medical expenses. So it's probably cheaper to say, hey, I'll pay the premium if that young adult is not able to afford the coverage on their own. And it's a great way to give them the gift of health, in my opinion. So another question is if anybody's going to transition off medical coverage or is going to move on to your plan this year. This is especially important to note and to speak with your financial advisor about because you'll have to be especially careful in your choices and the enrollment process. A spouse may be retiring and will either lose coverage or will need to be on your coverage, or you're going to have to either go out in the marketplace and get something for them. And we often see this with our clients. Maybe one of the spouses is a little bit older, and maybe they're going into Medicare, but the other spouse may be a couple of years younger, and they're going to have to go out there and get medical costs on their own. So even though you may not necessarily be affected by open enrollment, these are decisions that we do help our clients with and something to keep in mind. The next questions are, what did you spend last year, and what are your anticipated healthcare expenses this year? Of course, that means that you need to honestly examine a few issues. The first one, how is your overall health and that of your family? So we have a great resource that we found from General Mills that they put together for their employees, and that's been widely copied and used to help people evaluate their health honestly. And we're going to send you a link after the call, but if you answer these questions, you could use this assessment to help you decide if you're going to, maybe you want more coverage because you anticipate that you're going to have some additional medical costs next year. Another item to consider is if there are any chronic conditions that require consistent treatment and ongoing medications. So, for example, we often use our own personal life as an example for clients because we're not immune to things happening to us. So my husband has a chronic condition and he has multiple medications that he needs to take. On the other hand, I only see doctors for my wellness checkups and I take no medications. And occasionally need a doctor for a cold or an accident, but it's not routine and is usually a surprise. So we made a family decision that he will take on a separate healthcare coverage than I would at work. So we decided that he's going to take his own healthcare coverage and I'm going to take my own because since I don't have to go to the doctor that much, I could afford to take one with a higher deductible. So that's something that you'll have to evaluate. Another thing to think about is if you have any possible upcoming procedures or surgeries. So do your research. How much is that going to cost? Because you don't have to be on that plan forever. You could always change the plan. If you think next year is going to be different than this year, then you should definitely keep that in mind. And the last thing, the last two questions address what your options are for coverage and what will be the most efficient way of paying the bills. So we'll explore that more in the next couple of slides.
So to help answer all of those questions to protect yourself against medical bills, we've actually put together a worksheet that can help you calculate and estimate what those costs are, what costs you may have had in the past, which ones you may have upcoming this year, and which plans may be a little bit more beneficial as a result of those costs. Generally, there's two types of plans. Either it's a lower premium, higher deductible, or perhaps a higher premium and you have a lower deductible. And it all depends on what those expected costs are going to be for that year. So in this worksheet, you're going to be asked to rate your own health status. Look back at your expenditures for last year and determine approximately how many doctor's visits everyone in your family or in your plan will have. It's going to help you project several factors moving forward. In addition, it allows you to enter information on different plans that are made available to you and to put the information into a usable format. Generally, when you're looking at these health plans, it's laid out in the summary. It's not very easy to read. And just thinking back on, the things that you've spent on and what you're probably going to spend in the future, it's a lot of different factors, and this worksheet does a nice job of putting it all together in one spot. This tool serves as a generic form. So if your employer does have one specifically for your options, we do recommend that you use this one. But if you don't have any other kind of tool to use, this is a good one to use. And if you need help in evaluating those options and you're a Tobias client, please contact us. We're here to help you. Generally, we're thought of as the investment managers, but we do help clients with a wide variety of things, and this is definitely one of them. It's those employee benefits. As we already saw in that stat slide, most people spend less than 30 minutes reviewing their benefits. But as we already know, the cost of only spending 30 minutes could be many thousands of dollars. So don't skip on this evaluation. And remember, this is a resource readily available to you, so please contact your advisor. You can see some of the questions the benefits evaluator is asking here on the slide. You may not know the answers to some of these questions, like how much surgery might cost. But listen, if you know you're going to have a surgery or procedure coming up, or if you're expecting a baby, the doctors and hospital can actually help you estimate and even evaluate your insurance options with you ahead of time. So you do have that dollar amount in mind before it even happens. If it starts feeling overwhelming and you're thinking of giving up, remember your financial advisor is here to help.
We can't emphasize it enough. We're here to help. Okay, so here are some thoughts to consider when you're comparing your healthcare products. The first one is not to assume that just because the name of the plan is the same from last year that the coverage is the same. And I hear this all the time, like, I just picked the same thing as last year. And I'm like, it's not necessarily the same thing. So you really need to check that from year to year. So read the plan offerings and see if you're comparing apples to apples or apples to oranges. The next thing is don't look at the price of the plan don't just look at the price of the plan or the copays. And I've been guilty of this before, I told you. So you got to look at the details beyond the copays, but also look for things like physical therapy, emergency visits, percentage of costs covered after deductibles, and all the fine print details that are usually under the hood. Third, if you take specific drugs or get treatments or use a specialist, then ask for a written response on how they're covered. This will give you a better idea of the plan minimums and what out-of-pocket money you're going to need to plan for ahead of time.
So I'm actually going to go back to a different part of that worksheet. So when you're using our Benefits Evaluator workbook, you can easily compare in and out of network offerings by looking at those plans side by side. You can look at plan types, individual and family deductibles, and maximum out-of-pocket expenses. And one of the biggest things that's important to know when you're looking at these health plans is whether or not your doctors are in network. And if they're not, then what are the consequences for them being out of network? There's generally a big discrepancy in whether or not they're in network or out of network and how much that's going to cost you out of pocket. You'll also be able to estimate the cost of your usage for anticipated doctor and emergency room visits, co-pays for brand name and generic drugs, as well as other services like alternative medicine, if that's something that you're interested in. You can do this both for in and out of network co-pays and come up with an estimated projected cost for the year. This helps plan for your budget, health coverage, and contributions to a flex or health savings account, also known as an HSA. By adding these expenses in the premium, you can easily see which is the least expensive plan overall. So this is really taking into consideration all the factors, not just the lowest cost premium, because given all the costs, that may not be the best option for you. So we really want to look at what's the total cost and what kind of plan is going to help cover you and in the end result in a less out-of-pocket dollar amount for you. Most of these categories are going to be easy for you to answer, but if you don't know the answer to something, don't feel afraid to go to your benefits provider or your HR department. They're there to help you with those kind of questions. Don't let confusion stop you from this exercise. This is a really good one to practice, and also just be aware, what are those expenses? They're going to come up whether we want to think about them or not, so it's best to be ahead of the ball and just know what they are ahead of time.
Can you tell me when you to stay healthy and be prepared? We're not biased about health at all. Okay, so there are two ends of the spectrum here to consider when making that health plan decision. For some, it makes sense to use a plan that will require high monthly premiums with lower out-of-pocket costs versus one with lower monthly premiums with higher out-of-pocket costs. So remember, the goal here is to protect yourself against potential high medical bills. For some, it won't be a clear-cut choice. So talk it through with your financial advisors, talk it through with your family, your HR department. Just make a wise, informed decision. On the left side here on the slide, you're going to see some things to consider when you're using a plan with high premiums that may require lower out-of-pocket costs. So if you're going to pick that type of plan, then you're going to probably frequently see doctors. You have a history of emergency care. You take expensive or brand name medications on a regular basis. You may be expecting a baby, or you plan to have a baby next year, or you have small children. You planned a surgery. You have been diagnosed with a chronic condition. You prefer certainty and a level of pocket expenses compared to smaller premium outlays that could possibly be requiring you to come up with a higher deductible. So keep that in mind, because this one is typically lower deductibles and lower maximums. On the other side, you'll see that you may consider a lower premium plan that may require higher out-of-pocket costs if you rarely see doctors. So this is good. Like I used myself as an example earlier. For my husband, I would pick the other plan, the one with the higher monthly premiums. But for me personally, I would go with one with lower monthly premiums, because I'm basically, I would say, in good health. I participate in activities that don't necessarily put me at risk of going to the emergency room. I don't take any drugs at all, but for this, if you take generic drugs, they're still pretty inexpensive. I don't have any planned family changes. I don't usually exceed the deductible, so that's fine. So if this describes you, for example, then you might choose this plan, and you may also utilize a health savings account to go along with it. And I can't emphasize that enough. The security that you're going to build by having those extra pre-tax dollars on the side in that health savings account is going to be amazing. This is really good too if you're young and healthy. We have a lot of clients that are just starting in the workforce, and they don't even have children or anything like that. So it's a good opportunity for them to start saving now for the future.
So now we're actually going to move on to dental and vision. So very similar to how we evaluated health insurance, you really should spend some time on dental and vision. Don't let dental and vision expenses leave you cross-eyed. Had to throw that in there. So dental bills especially can be really expensive. Now, it's not the routine 6-month cleaning and visit or even the occasional cavities that are going to cause the problem. It's those things that you don't expect. It's teenagers with braces, seniors with bridges and implants, or even if you're middle-aged and you're getting crowns or teeth removed, those are the ones that are really going to drive those big dental costs. Even when I was in my 20s getting my wisdom teeth out, that was a nice big dental costs that I was really trying to avoid. But sometimes those teeth just make it known that it don't want to be there. So what excuse me. So really what's driving people to the dentist is either because they're paying for a benefit or they don't want to lose the money, or they're actually in real pain. But the real benefit of coverage is in prevention, when people can go and avoid many of those major expenses by taking care of their teeth routinely. A side benefit is that by planning these expenses ahead of time and utilizing the insurance and flex spending plans, you will know that your medical, dental, and vision bills will be covered, and you won't be relying on credit cards and take out high interest loans to pay for those procedures. It's those unplanned procedures that people frequently say cause them to go into debt. So here are some easy steps to help you plan ahead for the expenses you may incur next year. You could collect past dental bills and vision bills to see what you spent each year, last year, and it should give you a good idea of what you expect to spend in the upcoming year. You can also ask your dentist for a list of procedures they think they may need next year and quotes for those costs of procedures. Do you need a root canal, a filling, or cosmetic work? Ask for any of the suggested plans that will cover for your type of expenses, and if any of the options at work include them. Be aware that some of the plans make you wait a year for some procedures or have maximum lifetime limits for certain expenses. Think about and project vision needs for the next year. So maybe you want to switch from frames to contacts or vice versa, or maybe even add a prescription to your sunglasses. And to make it easy to decide which plan to use the dental and vision comparison pages on that Employee Benefits Evaluator workbook. So that's that spreadsheet that we're going to send out to help you guide you on the level of coverage you'll need by adding up those anticipated costs.
And I wanted to add something there, something funny. Well, not funny, but from the dental piece. So my husband calls me today, says that he went to the dentist and they wanted to charge him $410 for a cleaning. And I said, wow, how dirty are your teeth? And so he said that there was a waiting period before certain benefits will kick in for him for his dental piece. So keep that in mind as you're going to the dentist. You might want to ask also, what would be the cost if I get my cleaning today, or do I need to wait 3 months or 6 months before it's fully covered? So, the financial planner in me, I said, I love these curveballs you throw at me, Michael. But he's going to get his teeth cleaned. Nobody has to worry on the webinar. But it's good to know, right? Because as we're planning ahead, and we're transitioning to a new job, for example, we might want to go to the dentist before we leave that previous job, before we go to the new job, because it may be like a 3-month or 6-month waiting period before you have access to those benefits, and it could be really costly. So setting up an appointment that takes you 5 minutes to do is worth $410 ahead of time, I would say. So
absolutely, take advantage of those benefits that you're paying for. We don't really go into it here, but if you're paying for these benefits, use them.
Absolutely, yeah. You don't want to leave money on the table, that's
absolutely.
For sure. So here on the next slide, I don't know, a lot of people don't know this, and we encounter, clients that sometimes don't know that this is accessible to them, but a lot of the health plans are now paid on a pre-tax basis and pre-FICA. And this is really important because of that, plus the 10% floor on deducting medical expenses. And, we have a CPA kind of look at the way that we do financial planning here. We always are looking at taxes and how to help our clients reduce taxes. So we're like, you got to have a flex plan or an HSA plan because of these reasons, and this is it. So since most people are not able to deduct those medical expenses at tax time, it's really important to take advantage of these other plans. So that flexible spending plan or a health savings account, if it's offered by your company, it's great, because they're going to allow you to pay for medical and dental and vision expenses pre-tax. So that is fantastic. Now, there are some rules about using or losing them, and especially when it comes to those flex plans. So that makes it sometimes a little bit more difficult if you are not planning ahead of time, but we're advocates of obviously planning. We're financial planners, but we can help our clients with that. So if you think that you have this procedure coming up next year, and that's the reason for using the spreadsheet, then you might say, okay, I'm going to put this number of flex dollars in my account because I know they're going to help offset that expense. The rules with that, though, is that if you don't use it by a certain time frame, you may lose that money. Ideally, you should use it by March of the following year, but they are allowing you about a $500 that you could carry over to the next year. That's for the flex plans. Now, the health savings accounts are different. You could keep that and you could use it forever. But I just want to keep that in mind as you're thinking about which ones to use. And especially if you're having babies, we have a client that is planning for a baby, and we're like, okay, well, let's compare your plan versus your husband's plan. What are the benefits? What money do you need to set aside? And let's put that in the plan, and also thinking about childcare, right? Because some of the flex plans will allow you to deduct some childcare expenses and even summer camp expenses. So there's a lot of flexibility here to use the government to help you meet your goals.
All right, so we're going to switch gears here for a minute and take a look at a benefit that is cropping up more and more through employers, and that's going to be long-term care. So we discussed long-term care and retirement planning with our clients because it's one of the biggest threats to a secure retirement. Taking care of your health in the future is as important as taking care of it now. And more than 50% of seniors will need some form of long-term care in the future. The bad news is that over half of those who are 65 will have health conditions that prevent them from getting coverage. And the industry is changing rapidly as boomers are defining what they want and need. So we strongly urge you to address long-term care when you are between the ages of 40 and 55. And we do encourage you to talk to your financial advisor if this is a concern, so we can look at the different options that you have available to you. So here's what to know if this is a benefit that's offered by your employer. The great news is that premiums are tax deductible for long-term care. If you have a chronic condition now or family history that may require additional care in the future, this may be your best option for getting coverage. And now the details are really beyond the scope of this presentation, but again, let us know if this is something that's offered and we can help you navigate those options for you.
So now moving on to life insurance. The most recent research has 100% of actuaries in full agreement of one thing, and that is that we're not going to live forever. Haha.
I didn't know that, Kat.
You didn't know that? Now you know. If a spouse, child, or anyone else depends on you financially, then taking advantage of group life coverage is an easy way to solve this problem. With that in mind, it's important to do a few things. One, if you don't have enough life insurance coverage, then don't pass up the opportunity to get coverage without the need of a medical examination. Often employers will give you a minimum amount of coverage. Sometimes it's ranging between $25,000 to $50,000, and also offer the option to get 1 to 2 times your base salary for a minimum monthly cost. So if you have a spouse, you may also be able to get some coverage for them to help offset some expenses. So think about, maybe covering a child's partial education or childcare or pay off your mortgage. Think of it that way. I know that my husband usually gets this and we joke about it, and I say, I know what you're going to do with that money, Michael. You're going to buy yourself a new car, but I'm okay with that. But in all seriousness, I had a client in the past that decided to pass up the group life insurance because they said, I could probably get something else on my own. And what was really sad is that when he gave that up and he went to get individual coverage and he went through the medical examination, he found out that he had cancer. So he was declined. And he also didn't have the group insurance. So that just began a road down to, financial distress, significant financial distress. He also ended up leaving his job within 60 days. So this became really, really difficult for him and his family. And one thing to think about is if you say, okay, I don't need the coverage, or I don't know if I need the coverage, well, what we say to people is get the coverage now. You could always go out into the market and price things out, and you could drop it next year, okay? But get as much as you can right now because this is guaranteed. Please do it. And if you leave your job, you have 30 days of leaving your company to convert that to an individual policy. So make sure that you do that because you can't afford to not do this. This is so important. And if you need a resource to find out how much you need, there's a link here, lifehappens.org. They have some really nice calculators that you could research to figure out how much coverage you need.
And now we're going to move from life onto disability plans. And I found it funny that Kat earlier when she was saying when people evaluate the coverage, they say things like, I don't plan on getting disabled this year. And what's sad is that no one really anticipates this happening, but being disabled could almost put a bigger wrench in your plans than passing away. The reason for that being is if you pass away, your survivors need to continue living, but if you're disabled, you need to continue living, and now you're not working and bringing in income. So this could be really a huge issue if you do become disabled. And more than 25% of the people in the workforce are going to experience a disability prior to age 65, and that's going to result in a significant loss of income. So unless you have all the money accumulated that you need until you pass away, you're going to need this coverage, especially if you have dependents. So take what you can get. If you need to cut expenses, you could see if there's a longer elimination period, so that means how long until the policy starts to kick in and pay out. If you do that, you can save premium dollars to increase your emergency fund. Sometimes there's an optional supplemental short-term coverage, and it's usually inexpensive. So sometimes we hear from clients that they do find the coverage very expensive, and the reason for it is there's a higher likelihood of it happening, which just makes it that much more valuable. And the truth is, you can't afford to not have this. So call your financial advisor to find a strategy that will work to help you pay for it. Sometimes just cutting back for a family meal or two a month can help in offsetting the cost for that policy. For a risk that could really become a long-term financial strain on you and your family. So in case you couldn't tell, we're pretty serious about this. You really should have at least some form of disability, if not as much as you really need to continue living a comfortable lifestyle if something happens.
Absolutely. And so there's other optional benefits, right? So your employer is going to have this meeting coming in October, November, and tell you about all the other things that you might want to sign up for. And we want you to explore all of your options because companies may change things up for this year. So look at these options, again, as solutions to life's potential problems. And it's also a way to help you get ahead financially, okay? So be really careful with your planning. And some of the options that we want to make you aware of is first, 401k retirement savings plans, because often an employer is going to match you maybe 2, 3, 4, 5% of your salary, which means free money, okay, from your employer. And it means that you're going to be that much closer to your financial freedom day. And I know you want to have financial freedom, especially if you came on this webinar. Another one may be stock purchase plans, which are often sold about 10 to 20% discount and can be used for children's college funding as gifts or to meet your future goals. You also have some corporate executive benefits like non-qualified deferred compensation and other types of plans. So we ask that you reach out to us since we have the expertise in helping you navigate those options. Plus, we could outline for you the possible tax implications and help you save some money. There's also wellness programs out there that maybe you get a discount for going to the gym. Like we said, your health is so important, and it's also going to dictate a lot of the choices that you make. So if you're going to the gym, I always tell people when we meet that it's something to be budgeted in your budget. Make it a budget line, but if you could get a discount for going to the gym, that would be amazing. And we also see some companies out there that are now designing financial wellness programs. It is something that we offer through our 401ks when we have clients, is that we do financial clinics for their employees to help them bring more peace around how they're managing their finances. Now, the next one, there are some trends, and I'm sure if you're into benefits at all and you're watching some of the news, paid family leave, this is one of the biggest ones that we see, especially millennials really, really want when they're choosing an employer. And the other one is student loan repayment plans. Actually, millennials love these two in particular. I'm not a millennial, but I like it too. Those millennials have such good ideas. That's all I have to say. So what's really great about these benefits is that they're attracting and retaining employees of, millennials and other ages too, because we find sometimes that we have parents who are taking student plus loans on behalf of their children, and is really putting them in serious financial strains, right? But if your employer launches a program where they incentivize you by saying, hey, we're going to pay off a portion of your student loan, maybe, they'll give you $2,000 a year, whatever that might be. I mean, it's $2,000 that you didn't have to pay, but it's solving a life problem, and that's reducing debt, right? Because when you free up money, then you can use it for other things that are far more important. The other one is paid family leave. And so if you've been listening to the news, like I said, you've heard a lot about this. And this is really important because as you're planning for that baby, or if there's a medical emergency where you have to take care of your family member for whatever reason, you're a caretaker, this is a great way for your employer to help offset some potential financial distress for you. So I just wanted to put that out there. You don't necessarily pay for these benefits, but if you are, in contact with your HR department, you may want to throw it out there as something that you're interested in because this could really help you save some problems in the future. And I have seen in the past that they also kind of make or break choices between employers. If somebody is being offered the same amount of money for a job, but one employer offers some of these things that another employer may not offer, they may want to choose that company over the other. So if you have a company that's offering you this, right, when you're thinking about paid family leave or student loan repayment, and you're actually offered a job maybe that pays a little bit more but doesn't have any of these benefits, we do encourage you to look at the entire picture because this could really be helpful along with the other benefits that we discussed. Okay, and lastly, here's an action list for this month, okay? We could send you the worksheet so that you could compare your plans, look at the enrollment documents and determine what's best for you, estimate your flex plan needs and determine if it's a flex plan or a health savings account that is best for you, review and estimate your insurance needs, consider the how to leverage low-cost employer-sponsored group life insurance. This is really important. I can't emphasize that enough. It's really very inexpensive to get. Look at the disability insurance. Take advantage of your 401k plan. Look at some alternatives like stock purchase plans and so forth. And talk to your employer. If there are things in that benefits packet at open enrollment that you don't see that you want to see, I would encourage you to ask for it. You never know. They might listen.
The worst someone can say is no.
Absolutely. So we want to open it up for questions. Anybody out there that may have a question, we'll be happy to answer it at this time. You can just type into the chat box.
Absolutely. But as you start typing some questions, I did want to ask Kat, do you mind explaining a little bit more in detail how an FSA differs from an HSA, or FSA is another word for the flex plan, the flexible spending account.
Mm-hmm.
So how do they differ? Because you mentioned the FSA, you use it or you lose it. The HSA, it just keeps growing. So why wouldn't I just get an HSA?
That's a great question. It depends on the plan that you choose, right? So if you have a high deductible health plan, then your option would be to have a health savings account, right? And sometimes the health savings account may not necessarily be offered by your employer, but you could go out there and get it. Mm-hmm. And I may choose that plan if I don't anticipate using the dollars for my medical expenses, because I may have the funds in an emergency fund, for example, right? Mm-hmm. So if I know that my deductible is $6,000 for this year, I have that money in my emergency fund. So I'm going to bank as much as I can in the health savings account, which is about $3,400 this year, because I'm going to get a tax deduction for that. It's going to grow tax-free. And if I need to, at some point in the future, use it for medical expenses, I use it tax-free. So it's a trifecta of tax savings.
Love that.
And I could also invest the money. That's the difference, mm-hmm. right? With that flexible spending account, I don't think it's a bad idea to use at all. I mean, if you have a different kind of plan, like a PPO, you might want to pair with a flexible spending account. Mm-hmm. I'll give you an example. I have a good friend that has children that are getting braces right now, right? So she's like, well, I'm going to bank those flex saving dollars I'm going to need to use them anyway. So right now she's getting a tax deduction, and she's going to be using it before the end of the year because she already has the braces plan in place. So that's why we use it. But a reminder is that you do have a time frame for those dollars to be used, right? So keep that in mind.
Excellent. And actually, as we were talking now, somebody wrote about the HSA. So can I have an HSA if my employer doesn't offer one? And the answer to that is yes, absolutely. So you can have a high deductible plan. That's really the only condition for the HSA, the health savings account. You need to have a high deductible health insurance plan. And if your employer doesn't offer the HSA, the health savings account, you can actually go out on your own and open it. And it's not going to come out of your paycheck, but then when you go to do your taxes, you let them know, hey, accountant, I've made a contribution of $1,000 or whatever it may be to my HSA, and they're going to you're essentially putting after tax dollars into it, but then you're going to get a deduction on your tax return to make it pre-tax. So even if your employer doesn't offer the HSA, you can still go out and do it on your own.
Okay. Yeah, very good.
And let's see, we do have one last question here. So Kat, if I started a new job, how long do I typically have to wait to get those benefits?
That's a great question, and it varies depending on the employer, right? Because once those rules are in place, it's the same thing for everyone. So even if you think you could really negotiate it, sometimes you can't. But it could be as soon as you start. It could be like the first day of the month after you start. I actually worked somewhere where they did that. It was a great way to entice me to work for them. And then others could be about 3 months before you do that. So we really want to prepare during those job transitions, especially, right? Because like I said earlier, if you know that you're going to be leaving a certain place of employment and you haven't gotten your dental cleaning, I would go to the doctor before that, because it could take 3 months before I could go again, right? So I would go get my medical exams. If I have any medicines that I need to refill, like we had to do that with my husband when he was transitioning jobs, I'm like, go to the doctor, get your 3 months prescriptions, let's go. Otherwise, it would have meant that we would have to pay full price out of pocket, right? So then that's going to hit my emergency fund, so I don't want that. So we got to plan ahead.
Out of control.
I know. We can't have that in my house.
All right, and we have another question here. Can I only make changes to my health insurance plan during open enrollment?
Well, so you could make changes depending if there's some life changes, right? So usually yes. The answer is usually yes during open enrollment. So if I'm single, I started working somewhere, and come October, I'm selecting my plans for next year, okay? But it could be that you had a child, for example, right? So then that would be a situation in which you would go to your HR department and say, okay, I have a baby. Now I need to add the baby to the plan. Or guess what? You decide to get married. Congratulations. And you want to add your spouse to the plan. You could do that. Or you got divorced. You could remove them, So there's some life transitions that may allow you to make some changes to your health plan. So I would encourage you to keep that open communication with your HR department. They usually will give you something during open enrollment telling you exactly what things can trigger a change. But this is really important because I had somebody that missed that time frame. So they got married and they really love each other, so romantic. They went on their honeymoon. And he forgot to add her to his insurance because he missed that 30-day period. And I said, oh my gosh, that is like the worst gift that you could give your new spouse, is not to put him on your health plan. Of course, that's what I would say. But that could be really scary. So you got to be really careful with these time frames because they're tight. So if you're making those changes, you usually have about 30 days before they could be implemented.
Yeah, so that's great advice. So just be aware that you do have the opportunity to make changes other than an open enrollment, but be aware that it is a short time frame, and just let HR know if you do have one of these life transitions, maybe even beforehand, so you don't get lost on the honeymoon and forget to do it afterwards.
Yes. All right, so we just want to thank everybody for being here today and spending part of your lunchtime with us. We so appreciate it. We have other webinars coming up. We'd love for you to join us. We have one on the market outlook coming up, and we have one on year-end tax moves, which if you like to save money and you pay taxes, you might want to come. All right, so thank you so much, and we'll be sending something out after the call with that evaluator tool so you could try it out and give us some feedback. Bye, everybody.
Bye, everyone. Take care.